Hi there, Alpha Team. You join us on Washington's Day, President's Day in the States. So there's a bit of a half-hearted session ahead. Really, we'll probably see some continued volatility after what happened on Friday and the sell-off close. And really, it's a bit of a quiet week data-wise. So we'll spend a bit more time reviewing what happened last week to see how that set us up, and then look at a few charts towards the end and go through the talking heads that are coming up. And the start of the week, we've seen China reopen after Lunar New Year. It's a year of the dragon. Uh, Hoping to see a strong start, which it did. It seems to be fading a bit. And they dropped the ball. There was an expectation there'd be a rate cut this week and the 1 year of at least 10 bips, but they've failed to do that. It's supposedly blaming the strength of the US dollar. But in the meantime, Goldman Sachs have upped their price target for the S&P from 5,000 to 5,200. They're the bullish ones. Morgan Stanley, the bears, they've moved up to 4,500. And it's all based on earnings from both of them. They're all admitting that what we're about to explain is starting to play out. There is, despite the fact that the markets look stretched, there is some credible earnings underpinning going on. So last week, a conflation of inflation, the meeting of a couple of quite worrisome pieces of data for the early rate cuts. And that was CPI originally, which we talked about not being that relevant for the Fed. They use it as a broad measure of what's going on. But PPI, input prices for making things, they have a couple of elements in there, particularly on the services side, which feed directly into PCE. And that's what caused all the wobbles on Friday. We'll have a little look at that. Outside that, I think most of the problems for the market, it's in terms of yields and rates from the read through. And as I said, equities themselves, indices are underpinned. Gold finally blew away that triangle we'd been playing, so it's back to either the bullish nesting setup holding 1973, or what we originally proposed, which is a pullback of equal legs kind of idea. We'll have a look at a couple of setups on that. And we had obviously loads of speakers back post the meetings. They're able to give us the view of where most of the central banks are. We'll have a look at what they had to say. But the data was really mixed across the globe. It's ups and downs all week. Quite a quality week for trading, really. There was plenty of pivots and turning points. So the week started off as obviously in the Australasian session. We had a speaker straight up, which was New Zealand's Orr, continuing to moan about how broad the inflation is, so they're not going to be cutting anywhere soon, and that was reiterated during the week. Equally, ECB's Lane was the first out on Monday morning, quiet Monday last week, saying that they're quite worried over in Europe because they can't get the quality of data that they can trust, a bit like the Fed was saying. And then it was generally, as we go through a lot of the US speakers, Bowman started off saying it's too early. The trend is good, but everyone's worried about geopoliticals, that they may hurt the supply chains again. Fed Barkin, who is a mild voter, too early. Businesses might be slow to pass on price changes. And these guys are supposed to be looking after the macro environment for businesses, not telling them what to do. Bailey, he was first speaking before GDP came out, and he was saying that even if it did, it's set up. It was supposed to have two very small negative prints, which is the technical recession for the UK. It was the fact it came in at 0.3 on the Tuesday, which we'll talk about in a minute. That was all the problem. And Australia's Kohler said services inflation is still too high to even be considering a cut. So it's pushed back in the main from a lot of people. So the UK numbers early on Tuesday, CPI day, we had the wages out, and despite them still being relatively high, they beat the consensus numbers. They were lower. Ex bonuses and including bonuses were both below consensus, but unemployment was down to 3.8%. So a little bit of offsetting that caused GBP to have a bid to it, and we pushed back to only having 2.5 cuts for the year. And then Swiss CPI came out, and that actually missed the downside. Now they have a lot of government control, so you'd have thought that the predicting would have been much tighter last week, but that seemed to be a theme for the week. The economists were miles away on lots of prints. So data is still tricky, and it often is at the start of the year. And then German ZEW, I mentioned before that I don't treat that as strongly as IFO, but this is the financial analyst people, and their views are pertinent to the market. Obviously, within that, current expectations missed, but sentiment is starting to improve. But that was all taken before the US CPI print. And what a print. Obviously, there've been slight revisions down on those benchmarking numbers, but we're surprisingly firm there, and the core jumped 0.2% month on month, and the yearly, while still being below 4, jumped up to what it was for December. So a bit of a shock. Everyone was hoping that the downtrend would continue. Powell had already mentioned in his interview on 60 Minutes that it wasn't really needing better data, just wants the trend to be down. But this obviously wasn't a great print. So we got a sell-off which looked like it was overdue. We mentioned that last week. We went into it expecting it to be quite pivotal. The underlying setup for indices is good, but it's looking more and more stretched, and the bears are all over the negative metrics and narrow breadth. So it's a proper two-way pull, really. So is that a narrative change in inflation? Possibly not yet. Need to see a series of data points, and people are trying to be dismissive of the rent factor. So it's rents that are pushing up CPI, and we've talked about that Atlanta Fed thing. Everyone's expecting it to come through negatively, but it hasn't happened yet. And it's a higher weighting in CPI than in the PCE. So if you want to be dismissive of the data, that's why CPI isn't the one that's used by the Fed. And there'll be 3 more PCE prints before they have their May meeting. So there's lots for them to chew over. Generally, looking through the data, employment costs are the problems in the service side of the CPI, and they're strong Europe, UK, and America. So we need to find a way of sorting that out, or it's the productivity that we talked about last week as well. So that's within that. We then had a little print, which we'll show in a bit, on the DXY, which to me means it's going to extend higher. It very much looks like when we play through all this, 106 needs to happen before the sell-off, or somewhere close by. It's quite disappointing. It looked like we're going to get that turn, but if anything, the worst case, I think, from experience, is that we'll probably have a double correction on a lot of the global indices to allow for that dollar to go up. But we'll see how it plays through. Really, as I said, the issue is in bond yields. They came down from 5% to 4% very quickly at the end of last year. That got the rally going. We've backed up 40% of that, and we need to see how that works. So Wednesday, everyone woke up in a little bit more downbeat mood. Then UK CPI came in lower on improving services, feed-throughs, on PPI as well. But so GP, sterling was weak on the back of that, exacerbated the strong dollar, strong rates push on the US side. So, the main thing I think Bailey said on the back of that was that they've now moved from a case of how long are they going to be restrictive to how long are they going to stay higher. So the narrative is changing slightly. They're getting ready for when they can pull the trigger. Euro avoided the full Monty recession. Industrial production slightly beat. De Guindos was the main speaker in the early part of the week, saying that they need to be patient, and they're still expecting the numbers to be bad, but that's not going to be a reason for them to go early. Quite disappointingly, Nagel. It's always been about Buba, the Bundesbank. They've always been the ones who drive the ECB. Really, I know Lagarde's French and loves to be kowtowing down on everybody, but it's whatever the Germans want that really gets things going. And they're super hawkish at the moment. Rates have got to remain higher. They love squeezing it out. Historically, you'll have heard of the Weimar hyperinflation they had in the early part of the 20th century, and that still pervades in their thinking to this day. Still potential geopolitics. I mean, we keep seeing this. It was the investors' number one concern. It's quickly becoming the kind of central banker's tool. When all else is failing to control it, they'll just blame geopolitics at the moment. Goolsby was back on the tapes. He's not voting, but he says it's all about the rate of change of the path. They are looking at PCE, so that was quite pertinent for the week. But he quite rightly said they shouldn't be waiting until inflation hits 2% to have started the rate cuts. And that's what we've been talking about. It would be much more sensible for a lot of the central bankers just to start the process and talk through it rather than having to panic and chop them 50 and 100 basis points at a time. And what we were talking about last week, nothing more important than productivity. And that's what needs to continue helping in the States and needs to appear in Europe. Bar, once again, reiterating previous comments, CPI is on track, but a bumpy road. Oil inventories, crude actually started to see a bit of the thrust going out of it. And we'll look at that in the chart later on. Stockpile build of 12 million in the States, but there could be some pent up inflation read through from the gasoline side. The refineries were down much more than anticipated, not just planned maintenance, but some unplanned maintenance hurting there. And at the end of the day, Bullock again for the Australians, nothing new, inflation persistently there, particularly in services. So continued pushback in Australasia at the moment. And then we went into Japan's GDP. This was a bit of a shocker for the economists. Only 1 out of 34 predicted that they would hit recession. There's supposed to be a little bit of a bounce back for the January numbers. So as I was saying on our funny memes during the week, it used to be a tiger economy when I was growing up. Everything was about Japan until it blew up at the end of the 80s. So it's been a bit more of a tiger economy, as you saw from the picture that we posted. And that was it's quite important, I think, for the yen players out there, because the GDP missed on consumer spending, and the reasoning being that the wage increases weren't keeping up with prices. Now they're the only ones actually trying to get inflation into the system. And the sort of read was, if they're in recession, there's no way they're going to be tightening the rates. I mean, we've explained before, it's all about the carry trade. At the moment, the guy on the street in Japan can borrow super cheaply and invest it abroad, so they're making lots of money. But the Nikkei, ironically, is almost up to its 1989 high. So there is some domestic performance. What we need to do is find a reason to get that yen trade to unwind and bring the money home. And that would probably further bolster performance. But what it's really about is getting the wages into the system. They're having this shunto wage negotiation we've talked about that comes out in March. This is their multi-decade opportunity. And I feel like they won't miss it. They're just trying to play around the edges with the commentary. They've got to get that wage negotiation up above prices and get this wage price spiral up to the upside, and then we can get the rate cuts. So I think at the moment, even though a lot of the charts are set up to take the yen much, much lower, and everyone's idea, they don't want it lower, even though it sort of is a cheap yen is bolstering their export side of things. It's not the end game, so keep an eye on that. And I think a lot of those yen charts don't have to make much of a lower low relative to put in the move. You can easily argue, and we'll look at that on the GY later on. Just be very careful on taking on the yen until we know more through March and April. Be very tight on your stops. Thursday, not much from Aussie, all in line again. Japanese industrial production missed. And then the UK, as usual, a proper mixed bag. So net, for the week, we've had business investment up, investment production and productivity coming in better for once. And they're the more forward-looking metrics, which is why Bailey said he's not too fussed about the inflation, the expected recession, because the data we've had so far looking forward is much better. That's GDP is a backward-looking measure. And the main problem with the GDP print was that it was actually bigger than we expected. So that was due to personal services pulling back. We messed around with the hairdresser idea. I mean, you don't get to look as good as this, do you, without being all over personal grooming? Get out there, spend. Come on, get the UK going. So Man talking head, MPC's Man, not surprised by the weak GDP because she expected the H2 data to look quite poor, and that's what it's proven to do. To me, one of the key speakers of the week for once was Lagarde. And if you hadn't noticed it, she'd mentioned that wages was the thing really controlling the narrative in the ECB. the crucial thing there is the next wage data for the ECB, the EU region, doesn't come until after the April meeting. The argument has been, is it an April or June cut? That to me is just put a line through the April cut. We're definitely on June, and she's in charge and seems to be making that point every chance she gets. So the 4 cuts probably still likely, and with what's happening in the States, they may now be the front runner for the first cut. But I still personally would be surprised at that. They may go in line. And then we came into Thursday's usual US jobs data. That came in slightly lower again. So a firmness to the job market, which hasn't necessarily been appreciated. And you'd have thought that would have meant there was big retail sales in December, but didn't happen. Again, that could be seasonal because it looked like it was a lot of household goods and gardening equipment and tools and so whatnot. So a lot of people are putting that down to weather at the moment, and that may well disappear in the February numbers. Then again, looking at detail on the secondary kind of bits of data, they may not necessarily be highlighted every week, but things like Philly Fed and New York Fed have important elements to them, and one of them is prices paid, just like you see on the ISM data. The New York Fed and the Philly Fed both said that there was they'd seen higher prices paid. That immediately made me think that the PPI data was going to be strong on Friday, and that has potentials for PCE, and so it seemed to prove, but we'll talk about that in a minute. Waller, prior to the PPI, he wasn't actually making any Fed comments, but he had a big speech trying to deal with how people are paying for things in different currencies around the world, this whole de-dollarization argument, but he's presented quite a good case that the dollar was still going to be the predominant one, not much of a shock there. And then other data that we've kind of mentioned, which doesn't always get talked about, the TIC, Treasury investment data, and the Fed balance sheet. I mean, yeah, it's so badly written for the market. It's so difficult to get your head around which repos going where and blah, blah, blah. But I think on multiple reads, it looks like it's a small positive. The use of the overnight reverse repo continues to fall, and they're still selling down the balance sheet. Once they've got ample reserve room on that balance sheet, then they'll stop tightening, is the read through. So, and there are, again, the most pertinent speech at the end of the week was Bostic overnight, midnight time on the UK calendar. And he's a mild hawk, and he is a voter, so he needs listening to. He said, there's no rush to cut interest rates. It's not overly clear that we've got to where we want to be. Wants more confidence. He's always said the first cut was going to be in Q3, and he only wants 2 cuts. So we have to listen to him. He's he has quite a bit of influence. Sort of talking about there's pent-up exuberance in the market. They don't want to release the animal spirits. But he is looking at that tick and reverse repo data. And with it dropping below 500 billion on Thursday for the first time in over 2 years, that draining of the facility is going to tell them whether or not people are in a healthy position or not, so that they are going to be watching this bit of what's normally deemed to be secondary data. And then New Zealand's always back on reiterating what they said at the start of the week, 2%, the inflation target. They're still at 4.7 miles of room to go. And they moved their policy away from what the Fed has, which is the dual mandate, to only looking at inflation last year. So there's not a lot happening there until those inflation numbers come down. And then Friday, obviously, we had, what should we call it, a pivot day? Not sure it is, but I think it's certainly going to be in the minds of anyone that's putting money to work. That's a PCE shocker read through, and we'll look at detail in a minute. But that, you've got to factor in that might cause a pause. It might stop you putting your money to work until you've seen a pullback, blah, blah, blah. It's certainly pertinent. And like we said, we've got 3 PCEs to come before the most likely vote in May. So what really happened? UK, and to start with, the UK retail sales unexpectedly beat. I mean, having been revised down in December, that was the biggest jump since April 21 when we were coming out of the pandemic. If you strip that data point out, it's the biggest jump month on month since 1996, which we looked at with the train spotting meme, etc. But on a 3-month rolling basis, volumes are down 0.2%. which again is the best since August. So things are on a decent improve. Another set of data that Bailey was talking about, things are slightly improving. Got hit mainly by household goods, sports shops, department stores. Sorry, they were in the main the best ones. It was actual clothes shopping that missed, and food, seasonal, and with people being stuck in, lots of home deliveries, blah blah blah. Net retail sales up. Again, that put a bid under sterling, and then everything reverse engines once we got into the States because, well, actually back on the UK, that got the rates back to looking at 3 for the year, more or less, having been at 2.5. Definitely got 2, 90% of a third. But, caution, these numbers are good, but retail sales only makes up 5% of GDP. So it's a good, on the margin print, things are going better, but it's not going to drive the economy. Services in the main drive the UK economy. Hugh Pill was in Washington on Friday. He's the chief economist for the Bank of England, and he said he's only seeing tentative signs of hitting that 2% target. So he does like to err on the, side of caution. But services inflation, everyone keeps saying that's the baby. Wage inflation has to come down. So US PPI, in terms of PCE, that was really bad. There were some components in there which really jumped out. It was a big move anyway on the underlying prints. But the 2 prints that came through were in hospital outpatient costs, 2.2% month on month. Some people have put that through the sausage machine, and that will double PCE most likely to a 0.4 jump on the month. And then, ironically, for the market, portfolio management fees, that for some reason feeds into PCE. So the better the markets are going, the more happy we are, everyone's investing, we're getting charged more commissions. So why on earth people at Alpha Capital want to be paying more and more commissions? You'll see it. It's that horrible print you've got in your own P&L data. Don't pay commissions. Go for the spreads. Go for limits. But in the real world, this is what is causing problems. So even though that's pulled back from its 2% month on month in December, it's still a positive spot 7, which is quite hefty within that mix for PCE. So both feeding through, and I'm sure we're going to get some talking heads this week having to deal with talking about that and saying, giving it the old "I told you so," because we've been saying we need to see more data. Housing market continues to struggle. Housing starts down. Permits have been down. Next week we've got existing sales. That's being used as a bearish point by some in the background. You've got commercial real estate struggling. You've got domestic real estate struggling. These are precursors to proper pullbacks, but we'll have to see how that plays out. And Fed's bar kind of dealt with that in one of the final speakers of the week, saying that they're focused on the commercial real estate. They know where the bodies are. They're very happy that the credit agencies are ahead of the game. So for the moment, they think they can keep a lid on it, and that's been reiterated in Europe, as we talked about last week. Daily finished us off with a 3 cuts is reasonable, more patience, blah, blah, blah. We came in saying exactly what we said on the way out, but I want to hear what they've got to say about PCE this week. Net, so not overly helpful for all the data. They've got a few signs of life in the UK, but it's all about the inflation outlook, isn't it? And then this week, what have we got? So stocks-wise, some hefty earnings coming up. We've got NVIDIA. That's the Millennium tune that I've referenced, Robbie Williams. I'm sure we're going to be animal spirits with that. They're the AI king. AI, as the Manchester lot would say. AI, we're going up. And I'd be absolutely gobsmacked if NVIDIA comes out with a bad print. It could happen, but it's been responsible for 25% of the S&P move so far this year, and they've been the poster child. We've had good data from their peers, everyone apart from Tesla in the Mag 7 has smashed it. This would really, this would cause serious pullback if there's a miss from NVIDIA. At the moment, the market seems to be taking it on trust and looking to put in small consolidations. But, Wednesday night, after hours, eyes peeled. The US retailers start to look a little bit heavier on the slate as well. Walmart kicks us off pre-open on Tuesday. Lots of FTSE names this week: BHP, Billiton, British Land, Barclays, Antofagasta, Anglo-American, Glencore. So a lot of the heavy miners, Rio's there. Some of the banks, HSBC and Lloyds, Standard Chartered. Rolls-Royce is always a big industrial name, and they've been putting out some decent performance of late. So they might be a bellwether for what's going on under the hood in the UK. And in terms of Eurotrash, we've got the Swiss Nestle, Danone, and Allianz to come. Not a lot of data, as I pointed out earlier. They've got minutes in the main. Royal Bank of Australia, probably, from what we've seen, it's going to be quite hawkish. They're Tuesday morning. Wednesday night, FOMC. Is it not irrelevant now with PCE being at the forefront of everyone's minds? And the ECB, they're out on Thursday at 12:30 UK. I think from what Lagarde said this week, it shouldn't be a shock if she reiterates that. She knows what's coming out this week. So probably nothing done across all the minutes. I've mentioned US existing home sales are coming. S&P Global PMI prints all around. So this is not ISM, but you'll get the US one, and you get them all across the globe as well. S&P Global is a well-used information index for many economic data points. Germany's got GDP and IFO on Friday. Remember, I like to follow IFO. That may have tentative signs of a pickup. You never know. I mentioned that China was reopening and there were some positives mentioned, and that's what got the market to the futures had moved ahead of the reopening. So most rail journeys they've seen for 5 years, and e-commerce hotel bookings were up massively, 60% year on year. 8,200 local projects, according to local media, have been signed off for the immediate future. But they, as usual, dropped the ball by not changing the interest rates on Sunday. That would have been a great kicker to start the week off. But we'll see how that progresses. Obviously, there's a week of catch-up, and it is the year of the dragon. So I've said before, let's breathe some fire into the market. President's Day, you've got CFDs and futures are open for until 6 and 7 o'clock. But the underlying stock markets won't be opening. So there's probably going to be a muted effect, but it might make it quite volatile. Be careful. So chart-wise, you'll see in the pack, the dollar, I've mentioned it. We've had to redraw it because we've had the move through the 104 spot, 6 to 61.8 fib. Looks very much like we're putting in a WXY. We're halfway through that, having had the A leg, and we're in the retracement consolidator B leg, which looks like it needs to have another little look at the 104 level to complete that before we get 5 waves up. And this time, surely it's a proper top, because we can't get much higher than 106. We take out the starting point of the first wave down, and then we're going to have to redraw this. It may be that it's an expanded flat, but that's something we don't want to get involved in. It pretty much still feels like we're going to have this blast up in the dollar. There's rate issues in the bond side of things on the read through from the data, and despite the fact that all the bond supply that's been put in there has been swallowed up, we're going to have to spend a couple of weeks working through the data points, I think, and the nervousness. So just be careful there. If you're taking on the dollar, you might be suddenly getting whipsawed in the short term. And like I said above, if we get that dollar rise, that should just about provide enough time for the indices to put in what's probably a double consolidation. That'd be healthy, just to get a semblance of order back into the market. And the US 500, I've left it in the channel. It's been behaving in the bullish wave 3 channel. As you can see, it's hugging to the bottom. Even in the first instance of the pullback, it's respected the lower channel. We've rallied again on Friday. For me, it'd be healthy to put in a three wave consolidation here, break the channel, and then go back into it and carry on. So can we get that in place going into NVIDIA? We've got three future sessions at least, haven't we, to get that in place. Keep an eye on it. I do think especially with what I mentioned with Goldman Sachs and Morgan Stanley, the fundamentals are getting more supportive to this whole nesting and getting dragged up scenario. So unless something really negative happens, everyone is going to be scrambling. And even the bears, again, that have been looking at what they're saying. They've got to be careful, because on the Dow itself, which we'll look at in a minute, you can interpret what looked like a consolidation as being a triangle even if it's just tracing out a consolidation wave for the last couple of years. If you get a triangle in the B wave, then the third leg up can be one that just goes out of control, and taking on the impulsive waves is always dangerous. When you're looking for turning points, you want it to be mainly on the consolidation points, or when the waves are definitely really fully extended. If not, you keep getting the multiple fib extensions of the waves. It gets very painful, and you just start looking stupid because you've called the top about 20 times. So tech is reading through in the S&P. That's the reason why the earnings is so supportive. It's respecting the chain. All about Nvidia and Nasdaq again. That's pretty similar. The bullish blue wave 3 that we're following, let's call it an intermediate wave, but we'll just call it the blue wave at the minute. It's the higher degree. Look, that's really respected channel. I've not moved this channel. We've got what could be argued is a truncated running flat going on at the moment. Could be perfectly viable for it to go, but I personally, again, would like to see 3-wave, a little bit of a continued choppy rally, sell off into Wednesday, and then boom, back in the channel and up. And then we see this continued, follow through of 1s and 2s into 3, 4, 5s, and it just drags up and up, and that supports the underlying earnings data. This is not just exuberance per se. If the narrative changes, then I'll be as bearish as the next man. But I think at the moment people are looking at just persistent bearish metrics and trying to force a bearish pattern onto the market. 18,300 is that confluence of impulsive 1.68 reads from various setups we talked about last week, from the 1s and 2s below. To me, that is where we start to get the serious chance of a pullback. I still think they'll be light, but if we get a fourth wave in here, 17.4, 17.3, that may well be the repeat level rather than it being higher for the consolidations. But again, that would be healthy way of progressing a market forward. Don't get too negative. The Dow Jones again said you can look at this whole movement across in here as being a diagonal from there, and then you're getting a breakout which can keep dragging us up. At the moment, it very much looks like it'd be healthy to have a 3-wave double correction from where we are. It's stayed true to this channel. It's trying to break out. Pullback wise, spot 382 is where we should be looking for the fourth wave pullback. It probably won't go much lower because it'll be going back into areas that you don't like to see it challenging from the previous one peak over here, which is around the 61.8 fib. So I'd like to think it'll be a traditional wave 4. We'll obviously have to deal with that if not at the time, but I can see why people are making these bearish arguments. Look, we talked about the McClellan advanced decline oscillator before. There's been periods of disconnect into the 21, 22 top that had got a lack of momentum. We've seen before a lot of this advance has seen negative advanced decline, and it's ultimately there at the moment. And in aggregate, which we mentioned that weeks ago, once it hits those reds, it does tend to have a pullback. It's hard turning around that momentum. So it does look very much in the short term that consolidations are ready to happen. The dollar should support that. Don't play them with the top of the channel as being your kind of stop loss areas. But really, the setup, it should be an equal legs, hopefully. Be looking to buy into that on a pullback of what is probably only 0.5 to 1% in the main, isn't it? 3,700 points. The risk skew is probably still to the upside, bizarrely. The DAX, again, that's staying true to channel. I haven't moved that. We've talked about it being sort of trying to nest and move up. It's going a little bit sideways. Within that, I'd like to see a double correction again that takes us down to the bottom of the trend line, if not slightly overthrow, which is back to 17,000. It's only, we're talking about a percent pullback in the main. And it would still be valid to drop all the way back, a 5% pullback if things don't look as rosy from NVIDIA likely. And that would still be a valid wave 2 consolidation before we move ahead again. Doesn't have much of a look of being too negative at the minute. So Germany, if anything, it's had the kitchen sink thrown at it, and any signs of uplift from China, we'll see that rally hard. Gold, I mentioned the fact that the triangle is gone, so we're going back to the nesting idea. This low post the high in December is the key, which is the 1972 spot, whatever. So let's call it 1973 support level. Very much looks like that's going to get challenged. We took out 2000 for the first time in ages. We've reclaimed it, but this is a weekly chart. Very much looks like we're stuck in this downtrend channel here to finish off the C wave. It's just about where it ends up. Now, I've talked about this setup before being a leading diagonal. You get 5 sets of 3, and every time you get an even numbered leg, there's 2s and 4s. They're generally zigzags. So you get 5 waves, a 3 wave, a 5 wave down. The 2 big legs down are equal legs, and they retrace in total spot 618 of the previous wave, so of the wave 1, and that's already happened. That's the green line, so it more or less was perfect. If this third wave up to the all-time high retraces spot 618, it's the green line across here, meets the channel around the 1920, 1930 level. I've got this feeling that we're going to take out 1973 and land somewhere in between the lot, slightly truncated, just short of 61.8, honouring around the bottom of the current wave channel, downtrend channel, and then we're off to races for our all-time high move. That looks to me to be the favourite. If we do break 1973, then people will again talk about this 3 wave of being part of an expanded flat. If that plays out, 1800 is the ultimate low, but I think we'd have to have a prolonged period of rate problems, bad PCEs to get that one into play. I think we'll get exhaustion in the short term. Worst case, have a look at the top end of that channel, but keep an eye on it. We're back above 2000, but we've got a lot of volatility in this instrument at the moment, and to me, I'd be looking to sell it anywhere near the top of this channel in the 20s and definitely in the 2030s. Oil, I'm not sure how many of you play it, but that again looks like it's playing out a 3 wave, a WXY to put the B leg in. Previously, we thought it might have finished with a B at a W, but this looks like we've put in a consolidation leg X here, and we're winding our way up towards B. But I said we'd started to lose momentum, and look, this final thrust of the last of the end of last week, negative MACD momentum. Last time we had a rise to what was the A leg of that W. Very soon after we had quite a bit of a pullback into the channel. So we're grinding high. I think we're going to put in a top above 80. We've got equal legs of W and Y here, one at 82.99, and it intersects with the top of the channel in a few days, if a couple of weeks' time. So I wouldn't be surprised to get that in. So in the meantime, there's a chance we get a sell-off back to the bottom of the channel. It'll respect the X low and then up. But it could go either way. I said before, it's volatile enough. Try and play this channel. Look for any short-term gaps to play it either way. But it very much looks like before we get the proper resumption of supply taking over the direction for this market, looks like, and we said it at the beginning weeks ago, it needs to have an 80 print just to reflect everything that's been going on. And then I know a lot of people have been playing the Japanese yen, and I mentioned it earlier, that very much since the end of year 2023 low in December has been on a positive uptrend. It looks like it's playing out 5 intermediate waves to the upside, of which we've put a 1 and a 2 in on the current read. That would suggest that we're nesting and building up for an ultimate breakout to 200. In the current setup, we've had a pullback, and we're in a consolidator leg of what should be a 3-way for this 2. I'm anticipating just a tiny bit more upside on the GJ, on the GY, and then an equal legs takes us back down sort of the 187, 187.5 level, and that would also be around the 61.8 fib retracement. Now, what I've talked about is the fact that you could easily redraw this once you've got a new high in above that current 1 there. That you could redraw that as an overall 5, and that may sit in March over here, that the rally suddenly terminates because we get that shunto negotiation. We need to really look out for that, because if they settle that properly and at the highs, then the yen's set for some strength. So it may end up being just a consolidator of the path upwards, but be aware that this could suddenly have to be redrawn if it puts in a valid top, because that would be a 5 wave situation. So that's enough for charts this week. We've got a few talking heads that I've spotted so far. The Bundesbank are talking today and tomorrow. It won't be anything other than pushback. Nagel will reiterate that on Wednesday. Bowman is back. Jefferson, Cook, and Waller. Sounds like a 70s funk band, doesn't it? Let's see what they've got to say about PCE. Diary-wise, as I said, not masses. Have a look through it yourself. Anyway, good luck out there. Keep an eye on the dollar. Don't get carried away. It's going to be range bound. Good luck with your trades.